Hello everyone, my name is Bagas Mukti, and in this video I will explain a chapter of financial management which is managing current assets. This chapter focuses on how businesses manage their short-term assets to maintain liquidity and efficiency. Today we will cover four major topics: cash management, cash holding, the relationship between cash management and cash holding, and last is cash budget. Let's get started. First of all, we have to know what is cash. Cash is a legal tender, such as currency or coins, that can be used to exchange goods, debt, or services. It can also include the value of assets that can be quickly converted to cash. Let's get into cash management. Cash management refers to how a company handles its cash inflow and outflows. The goal is to ensure that the business has enough cash on hand to meet its operational needs while avoiding unnecessary idle cash that could be invested elsewhere for better returns. Why is cash management important? First, to maintain liquidity. A business must be able to pay its expenses, such as employee salaries, supplier invoices, and utility bills. Second, to avoid cash shortage. Poor cash management could lead to an inability to cover short-term obligations, affecting operations and reputations. Third, to maximize the use of excess cash. Any surplus cash should be invested in short-term securities or used to reduce debt, ensuring that the company gets the best return on its resource. How to manage cash effectively? First, forecasting cash flows. Anticipating future cash inflows and outflows to identify potential shortages or surpluses. Second, maintaining an optimal cash balance. Keeping enough cash for daily operations, but not so much that it limits investment opportunities. Third, efficient collection and payments. Speeding up receivable and managing payables to extend the cash available for other uses. In short, cash management is all about ensuring the right amount of cash is available at the right time. Next, let's get into cash holding and its management. Why do companies hold cash? First, transaction motives. Cash is required for day-to-day transactions, such as paying suppliers or utilities. Second, precautionary motive. Companies need to prepare for unexpected expenses or emergencies, such as sudden breakdown of equipment. Third, speculative motive. Business hold cash to take advantage of unexpected investment opportunities, such as discounted price on bulk raw materials. And last is compensating balance. This is a minimum cash balance that a company is required to maintain in its bank account as a part of a loan or credit agreement. It acts as a form of collateral, ensuring the lender that the company has sufficient liquidity to meet its obligations. Then, how to manage cash holding effectively? First, regular cash flow monitoring. Continuously track cash inflows and outflows to identify any discrepancies. Second, investing surplus cash. Idle cash can be invested in short-term liquid assets, such as treasury bill or money market funds, which can be quickly converted back to cash. Third, minimizing excess cash. Excessive cash holding can lead to lower returns. Instead, companies should find ways to use surplus cash productively, like paying off high-interest loans. Also, there is many other ways to manage cash holding effectively, like use a logbook system, insist on wire transfer of customers, synchronize inflow and outflows, use a remote disbursement account, increase forecast accuracy, and instead of holding large amount of idle cash, invest in marketable securities like treasury bills or money market funds. Next, let's get into the relationship between cash management and cash holding. Cash management and cash holding are closely linked. Good cash management ensures that a company maintains an optimal cash holding, neither too much nor too little. Too much cash will reduce profitability since idle cash earn little to no return, while too little cash puts the company at risk of liquidity problems, making it hard to meet short-term obligations. For example, consider a retail business during the holiday season. The company expects high sales revenues, but also need a buffer to manage increased inventory costs and possible delays in customer payments. Effective cash management ensures the right cash balance is maintained to handle this fluctuation without holding excessive revenues. Next, let's get into cash budget. A cash budget is a tool that helps businesses plan and control their cash flow. It estimates cash inflow and outflow over a specific periods. The purpose is to forecast cash inflow, outflow, and ending cash balances, used to plan loans needed or funds available to invest. The timing is daily, weekly, or monthly, depending on the purpose of the forecast. Monthly for annual planning and daily for actual cash management. Now, let's take a look at this example. Here we have the cash budget of a Bagas company for January and February. Here we have the inflow, which is collection, 77,000 for January and 72,000 for February. And then we have the outflow, which is purchase, wage, and rent. To get the net cash flow, we have to sum up the the outflow first. And then we get the total payment 64,000 for January and 55,000 for February. And then we get the net cash flow from collection minus total payment. And then here we get the net cash flow 13,000 for January and 17,000 for February. Then we have cash at start if no borrowing, 4,000 for January, 17,000 for February. We add them with net cash flow to get the cumulative cash. And then we get 17,000 for January and 34,000 for February. And then to get the surplus, we have to less them with the target cash. And here we get the surplus for January is 15,000 and the surplus for February is 32,000. That's all my explanation about managing current assets. I hope it's useful. Thank you and goodbye.